In 1998, two of the smartest men in finance, actual Nobel Prize winners, built a trading firm that couldn't lose. For 4 years, it didn't. Then it lost $2.5 billion in 6 weeks. Not because they were wrong. Their trades eventually worked. They just weren't alive to see it. This is the story of how being right can still bankrupt you. Stick around. Because by the end of this, you're going to understand why some of the best market calls in history still ended in liquidation, and why that same trap is sitting in your trading account right now. Let's rewind. The firm was called Long-Term Capital Management, and on paper, it was the closest thing Wall Street had ever seen to a sure thing. The man running it was John Meriwether, a legendary bond trader who'd made Salomon Brothers one of the most feared trading desks in the world. Sitting next to him, Myron Scholes and Robert Merton, two economists who didn't just study financial markets. They literally won the Nobel Prize for a formula that's still used to price options today. If you've ever heard of the Black-Scholes model, that's them. Add a former vice chairman of the Federal Reserve to the partner list, and you get a firm that raised $1.25 billion on day one. The largest hedge fund launch anyone had ever seen. This wasn't a group of gamblers. This was, by every reasonable measure, the smartest room in finance. And for a while, the smartest room in finance looked unbeatable. 20% returns the first year, 43% the next, 41% after that. Year after year, crushing the stock market while everyone else scrambled just to keep up. Investors couldn't get in fast enough. Banks were begging to lend them money. Wall Street didn't just trust these guys, it worshipped them. Because the strategy sounded almost boring in its simplicity. Find two things that should be priced the same but aren't. Buy the cheap one. Sell the expensive one. Wait for the gap to close. Collect the difference. It's called convergence arbitrage. And on a small scale, it barely moves the needle. The gaps they were trading were often a fraction of a percent. Practically invisible. So to turn invisible gaps into real money, they didn't trade with millions. They traded with borrowed billions. Here's the part most people get wrong about this story. It's not that LTCM's math was bad. Their models were some of the most sophisticated ever built for financial markets. The problem was what was sitting underneath those models. By 1998, LTCM was sitting on around $125 billion in assets, funded by roughly $4 billion of their own capital. That's about 30 times leverage. And that's before you count their derivatives exposure, which pushed their real market footprint toward nearly $1 trillion in notional value. 30 times leverage means this: a market move of just a few percent against them wasn't a bad day. It was an extinction event. And their models had one quiet assumption buried inside them, that markets, even in a crisis, would behave the way they always had in the past. That relationships between prices that had always moved together would keep moving together. That assumption held for 4 years. Then it didn't. August 1998. Russia defaults on its debt. It sounds like a headline that shouldn't matter to a fund built around US and European bond spreads. But markets don't panic in isolated little boxes. Panic spreads sideways into everything. Instruments that had moved together for years, the exact relationships LTCM had bet billions on, suddenly ripped apart. Every single leg of every single trade started losing money. At the same time, there was no hiding in diversification because it was never really diversified. Every position was secretly the same bet. That panic doesn't happen. And panic was happening everywhere all at once. The numbers from here move fast, and they move violently. LTCM enters 1998 with about $4.8 billion in capital. By late September, just weeks later, that number is $2.3 billion. More than half of it gone in the time it takes most people to plan a vacation. John Meriwether, the man who once ran one of the most feared trading desks on Wall Street, is now on the phone, trying to raise $1.5 billion just to keep the fund alive. And here's what made this different from any other hedge fund blowing up. LTCM didn't just owe money to a few unlucky investors. It owed money to nearly every major bank on Wall Street. If LTCM collapsed completely, the fear was that it wouldn't just take down one fund, it could take down the banks standing behind it and the banks behind those banks. So the Federal Reserve did something it almost never does. It stepped in, not with a government bailout, but by pulling together a room full of Wall Street's biggest banks and getting them to collectively put up $3.6 billion, just to unwind the fund slowly enough that it didn't blow a hole through the entire financial system. Now here's the detail that turns this from a cautionary tale into something much more unsettling. Several of LTCM's core trades, the actual bets on prices converging, eventually did move in the direction the fund had predicted. Given enough time, without the leverage forcing them to sell at the worst possible moment, a meaningful chunk of that portfolio may well have worked exactly as designed. Let that sit for a second. 2 Nobel Prize-winning economists and one of Wall Street's sharpest traders may have actually been right about where the market was headed. They just didn't have enough time to prove it, because the leverage they used to make the trade worth doing was the same leverage that gave the market the power to end the game before their thesis ever got to play out. And this is the part that should actually scare you a little, because it's not just a Wall Street story. It's every over-leveraged trade you've ever placed on a chart. Being right about direction and being able to survive long enough to see yourself proven right are 2 completely different skills. Most traders only train one of them. You can call the top. You can call the bottom. You can be dead on about where price is eventually going, and still get wiped out on the way there, because your position size gave the market a way to end your trade before it ever got the chance to be right. The market doesn't care how correct your thesis is. It only cares whether you can survive being early. LTCM had the best minds in finance, and leverage still erased them in 6 weeks. So the next time you're about to size up a position because you're sure about the direction, remember, sure isn't the skill. Surviving long enough to be sure is. If this changed the way you think about position sizing, that's exactly why this channel exists. Subscribe, because the next trader who blows up on a correct call might be watching this exact video.